Hey everyone, and welcome. Today we are diving into a really interesting trading tool, one that promises all the upside of high leverage, but without one of its biggest, scariest risks. We're talking about Gate.io's leveraged ETFs. Let's break down what they are and if they really deliver. So let me just ask you this straight up. Have you ever looked at 5x leverage and thought about the potential gains, but then that fear of a sudden market crash just wiping out your entire position stopped you in your tracks? For so many traders, that one risk is a total deal breaker. But what we're looking at today is a tool that was built from the ground up to take that risk right off the table. Here's our game plan. We're going to start with the basics, what these ETFs are. Then we'll get into how they work their magic. After that, we'll see how they stack up against other trading methods. And this is the important part. We'll cover exactly when to use them and when you should probably stay away. Let's jump right in.
All right, first things first, what in the world is a Gate ETF? Let's get to it.
Okay, so in a nutshell, a Gate ETF is a special kind of fund that tracks a crypto, like Bitcoin, and just multiplies its price moves by, say, 3x or even 5x. But here's the game changer. You trade it just like you'd buy any other coin on the spot market. That means no complicated margin calls and absolutely no risk of liquidation. It's basically leverage, but made simple. Now, you've probably heard of traditional ETFs, right? They're usually like a basket holding tons of different stocks to spread out your risk. Well, Gate ETFs completely flip that idea on its head. Instead of diversifying, they're all about concentrating. Think of it as a rocket ship built for a single crypto asset, designed to amplify its price moves, whether that's up or down. So how does this all happen behind the scenes? That brings us to section 2. The mechanics are actually pretty clever, but the best part is that you don't have to worry about any of it. It's all managed for you automatically. First off, the names make it super easy to understand what's going on. If you see BTC5L, that just means Bitcoin, 5x leverage, and L for long. You're betting the price goes up. See BTC5S, that's Bitcoin, 5x leverage, S for short. You're betting it'll go down. It's that intuitive. The real secret sauce here is something called automatic rebalancing. Let's just walk through an example. Say you put 100 USDT into a 3x long Bitcoin ETF. The fund then goes and opens a 300 USDT position for you. Now, if Bitcoin's price goes up by 5%, your investment gets a 15% boost, and it's now worth 115 USDT. And here's the really cool part. The fund automatically adjusts to apply that same 3x leverage to your new, bigger total of 115. In a strong trending market, this creates this incredible compounding effect, where your gains start making more gains. So now we know what they are and how they work. But the big question is, where do they actually fit in your trading toolbox? Let's compare ETFs to the other usual suspects. This chart really makes it clear just how unique these ETFs are. Take a look. See how, just like spot trading, there's a big no next to liquidation risk and margin requirement? But just like futures and margin trading, they give you leverage. And that's really the core idea here. You get the safety and simplicity of spot trading, but with the power of leverage. It makes them this really specialized tool that's just perfect for riding short-term trends. Okay, let's get down to business. In this section, we're talking about how you can actually put these ETFs to work in your own trading strategy. So let's just quickly recap the biggest advantages. You've got no liquidation risk, which is huge. No margin, so your capital isn't tied up. They're as simple to use as spot trading. You get that powerful compounding effect in a trending market, and the fees are low, just like regular spot trading. It's a pretty compelling package. And actually, finding them is super easy. If you're on the Gate.io website, just head to the trade menu. And if you're on the mobile app, you'll see a dedicated ETF tab right there in the trading section, next to spot and futures. Can't miss it. Now, this is probably the most important part of the whole strategy, knowing when to use them. These ETFs are absolutely built for markets with a clear direction. When a coin is in a strong, sustained move, either up or down, that automatic rebalancing we talked about becomes your best friend. They're also perfect for trying to catch sharp, quick moves, like a breakout from a pattern or a big reaction to some news. And just as crucial is knowing when to keep them on the sidelines. In a market that's just chopping around, going sideways with no real direction, that same rebalancing mechanism can actually work against you and slowly eat away at your capital. And that's also why these are absolutely not for a long-term buy and hold strategy. Think of them as a sprinter's tool, not a marathon runner's. Which brings us to our final and really important section, understanding the risks. Because trading smart means being fully informed. So let's cover the biggest risk factor and a few questions that pop up all the time. This quote explains the number one risk you need to know about, and it's called volatility drag. Because the fund rebalances every day, holding an ETF while the market is just bouncing up and down without going anywhere slowly grinds down its value. So even if Bitcoin, for example, ends up right back where it started after a week of chop, the value of the ETF itself will actually be lower. This is the main reason why they are not meant for long-term holding. Okay, let's quickly answer a few common questions. First, why did the number of ETF tokens I own suddenly go down? Don't worry, this is just an NAV merger. Your total investment value is exactly the same. It's kind of like trading in $101 bills for a single $100 bill. Second, what are the fees? There's a tiny 0.1% daily management fee that's taken from the fund to cover costs. And finally, do I have to manage any of this myself? Absolutely not. The fund manager handles all the complex stuff automatically for you.
And there you have it, a really powerful way to use leverage without that constant fear of liquidation hanging over your head. It's a tool that's designed for simplicity and for capitalizing on those clear short-term trends. So I guess the final question is for you. Now that you understand both the incredible power and the specific risks, where might a tool like this fit into your own trading strategy?